What's up, traders? In this video, I am showing you how to double your edge by combining supply and demand with smart money concepts, giving you high probability setups and precision entries in one powerful approach. If you have been missing trades or struggling with the timing, this will help you clean that up. So if you are serious about sharpening your entries and stacking confidence, make sure you watch this one all the way to the end. Let's get into it. So you can see from the topic, it is about the doubling the edge. So here is where we are going to use SMC, supply and demand, to make sure that we have an edge over the market. So how are you going to do this? Combining smart money concept, SMC, with supply and demand creates a powerful trading approach. How does this happen? So supply and demand will show you where the market is likely to move. So once you have known where the market is likely to move, then that is when now the SMC part comes in. What does SMC do? SMC now will tell you when to take the trade, especially if you want to use the sniper entries. SMC will tell you now it is time to pull a trigger. Okay, all right. When you combine these two together, they give precise entries and higher probability setups. The question is, why combine them in the first place? We are going to see that right away. So, supply and demand identified the key price zones where banks and institutions placed major buy or sell orders. So, how do you know that banks have done that? We will tell you right away. Look at this. We had the last buy to sell. This movement happened like this. So you mark this as a zone whereby we have the supply zone. What do? We wait for this price to come all the way up here before we drop to the lower time frame to look for entries using the SMC. Okay, so smart money concept now will add the timing using market structure breaks, liquidity, sweeps, and order block confirmation. Okay, so that is when now you need to see if the price is within the supply zone. You need to go to the lower time frame and you need to really check to see, is the price respecting the zone? And how do you tell if this price is respecting the zone? You are going to see all these market structure breaks, liquidity sweeps, and order block formation. That tells you it's almost time to pull a trigger. So for instance, we have this formation which is equal to the above one, and now once this formation has happened, the price left this zone, went all the way down, it has come all the way up here. Look at what happened. Before this price tapped into this supply zone, it engineered some liquidity just beneath the zone. This was to trap the early entrants, those people who want to trade out of nowhere. So once they saw this, they said the price has come to mitigate this fair value gap, and they just, jumped into this trade and they wanted to push this market down. But look, we do not trade from a fair value gap. We trade from a supply zone or a demand zone. Look what happened. This was just liquidity being engineered. I hope after you watch this video all the way to the end, you are going to be a better trader and you are going to avoid such bad setups like these ones whereby liquidity is being engineered and you are induced to jump in to become liquidity for those who are going to trade from this zone. Okay, now after this, what do? Once the price has come to this zone, now it is time you do what? You need to drop to your lower time frame. And the lower time frame looks like this. This is the lower time frame that has been magnified here. You see, there was the very final break of structure to the upside, and then this low that broke the structure has been violated. So we say this has given us the change of character. This is where we say timing using market structure breaks. This is the market structure break. This is the market structure break. But now we are anticipating to see market reversal. That is what we are anticipating because the price has tapped into our supply zone, and that is exactly what we are seeing happening here. After that, what do we see? There is this inducement, which was the very first way of inducing early traders to jump in, saying the market has already left. So when they jump in, they become the liquidity. So this price will come just up here, sweep them out, and then now give us the real move downwards. Okay, as you can see, supply and demand will provide the location. The way we identify this location is the supply zone. So what do you do as a trader? You wait for the price to come into your zone. Don't panic. Don't trade from any other place. Wait for that zone to be mitigated. So once the price has come to that zone, now it is time to bring the card of SMC. SMC will provide the signal to enter. How does it provide the signal to enter? This is how it does. It will give you that last push, and then that change of character, and then it is also going to tell you, look, we are inducing early entries, and once they are in, we want to take them out, and once we take them out, we are going to give you a very smooth ride to your take profit. So if you're watching this, I know you are not going to be part of the trap. You are not going to be trapped again. So watch this keenly, because I'm sharing a gem that is going to make you a better trader. So what does that tell you? This blend delivers both accuracy and confidence. How does it deliver the accuracy? You will know. I did not just see this change of character out of nowhere. I looked at the zone, it was supply. I waited for price to tap into it. Price has first of all swept liquidity of the early sellers who jumped in way prematurely before the price could touch the zone. And then what happens thereafter? When price took them out, it tapped into our zone. Now, after that, price does not just leave that place. Price is going to tell you, look, still there are some people who are going to jump into this market way early, and I want to take them out before I proceed, because the market must have the money to move. Money is the fuel of this market. So it will induce you, bring your money to the table, take you out, and then for those who know what they want to look out for, will benefit from your loss. And that is what happens. There is this inducement. Price behaves as if it is leaving this zone, and then what happens thereafter? It comes back. Some people will close their positions saying, no, this position is not going to hold. But in the real sense, the position is going to hold. Price had just generated inducement, and it's coming back to take out the inducement before it will give you the real move. So once you know where the zone is, once you know how to mark the structure, and once you know how to identify the inducement, you will not jump into the market way too early before it gives you that signal. Okay, so this is where the confidence comes in. You will trade and you will wait for your price to proceed to your way, because you know the reason why you have entered. Okay, all right, so now we want to explain supply and demand a bit in details. Supply and demand is a price zone, not a single candle. So if I can take you back a little bit, you can see how we identified this entire area. You see there was a first candle, second candle, and fourth candle. All these candles gave us a zone. Okay, it is not just a single candle, but the start of this opposite candle gives us that beginning of the zone. That is where we start, and then we end at this point. So we wait for price to travel all the way into this zone, because sometimes price can come all the way up here. There's no problem, provided it has not violated this zone. Still, it is within the zone. But the thing is, don't trade outside the zone, because look at this. If you found this price coming up here, you marked your fair value gap from here to here, you think the price has come to this, and then you say it has broken structure to the downside, it has come to mitigate this level, and you want to short this market all the way down here, not knowing that there is a supply zone sitting just behind your stop loss, then you become minced meat for dinner. So you bring money to the market instead of collecting money from the market. So that's why I was saying supply and demand is a price zone, not a single candle. And then traders draw the zone from the range where a strong move began. Okay. Number 3, the last opposite candle is just a marker to outline that zone, the way I explained. This way, you can have high probability of order fill because price often retests these institutional levels. Why do you think price is going to retest these zones? It's because we assume that when these big boys were selling the market, not every order that they wanted filled got filled. So it means their orders were filled partially. So the remaining orders, once the price comes back to where they decided to sell from, their remaining orders are going to be filled. So we want to leverage on that and move with the market together with the big boys. This is how it happens. Look at this market. The market was coming from down here. It paused a bit here. When it paused here, we see a very aggressive move up. This market came down here, tapped into this fair value gap. Look at this fair value gap. Some people think this is the best way to trade from a fair value gap and shoot the market up to this liquidity. But what happened? This price went up and then came down and swept this liquidity. That is why personally I do not like trading from fair value gaps. I like to identify supply and demand zones, wait for the market to come to those areas before I pull my trigger. Because when you trade from a fair value gap, there is a likelihood that price might come and sweep you before it gets to your intended point. Okay, so look at what happened. This price came down, swept this liquidity, but it never mitigated this zone. What did it do? It just wanted to clear the liquidity of those guys trading from the fair value gap. So once it took them out, it went up and delivered that liquidity here. There is those who said this liquidity has been taken out. The opposite candle that took that liquidity is this one. Okay, according to them, which is the wrong way of doing things, because there's this level that has not been mitigated down here. So if they mark this as their last candle, what are they going to do? They are going to put their limit order and their stop loss somewhere down here, which is very wrong again. So it was done intentionally to bring liquidity to the table. So when you want to trade from here, the market will sweep you and then they deliver the liquidity up. So as a good trader, what do? Mark the demand zone and wait until the price comes to your point, because at some point this price will eventually come to fill the imbalance. That's how the market is engineered. So once this market came down here, look at the way this candle was aggressive. It was trying to reject and gave these people even this bullish engulfing candle. It was very strong candle, so that you can add into your position, saying now this position is holding. But immediately this bullish engulfing candle formed, what followed? A very huge red candle to take you out so that you learn how to trade better. It went to the demand zone, and after mitigating the demand zone, we see this price going up straight. It did not even have anything to stop it before it could take out this liquidity. Look at what happened again. This price came again all the way to this zone, and then what happens? It is going straight up. Look, so from the fair value gap, you see the price is really struggling. It does not go very far, and then takes this, it goes to this level and then comes down. From here you see the price is moving straight up, and then tapping this zone, it's moving straight up. You don't see this price getting somewhere here and then starting to come down here, because this level is where the big boys have entered their positions. They must engineer liquidity because they need liquidity for their orders to get filled. Okay, smart money concept will focus on market structure, liquidity grabs, and order blocks. Entry is usually at the last candle in the direction of the move. Mark this. I am going to elaborate on this. This is where supply and demand comes in to help you get filled instead of missing on your entries. If you're going to use the last candle in the direction of the move, sometimes it works, sometimes it doesn't. But now, Why do I bring in supply and demand? Simply because if price revisits that order block, the setup can give tight. Look at it. If there's a condition, if price revisits that order block, the setup can give tight stops and excellent risk to reward. Everyone wants that. But price may skip the level completely. Mark this. Price may skip that level completely. Which level are we talking about? Last candle in the direction of the move. So I will show you right now what that means. So but price may skip that level completely, causing missed entries if SMC is used alone. Look at this. This is the same scenario. This was the higher time frame. This was 1 hour supply zone. So the price had moved all the way to this zone. We saw the very last break of structure to the upside. We saw the change of character, and then we see there's some bit of inducement somewhere here. Okay, maybe you can call it inducement or not, but one thing I want you to notice is after this impulsive move down, there was a small candle inside bar or inside candle formation, and then what happened thereafter? This red candle, before closing red, it came back to mitigate the fair value gap and then left. All right, this is not by accident. This is trying to tell you, look, price has already mitigated this level, so look for entries away from this imbalance, because we have already mitigated. Why do you think it has been mitigated? I will explain shortly. Okay, so if we saw this break of structure, change of character, and you see this as the last candle, look at that. I said last candle in the direction of the move. So when you try to find out the last candle, this becomes your last candle before, this move happened. So what are you going to do? You're going to place your limit order here, and you anticipate to find your entries, very precise entries, so that you can risk 3 pips and you get 1000 pips. But does it work? Okay, let's see. This is what happened. Price came, price left here, came up. This was the farthest move it went. You remember what I told you? Once this level has been mitigated, this imbalance has been mitigated by this. Because how do you identify a fair value gap? A fair value gap is formed by 3 candles. So this is the first candle, second candle, and third candle. Okay, so this space between here and here is a fair value gap. So once a candle has traveled inside that fair value gap, we say that fair value gap has been mitigated. So we do not expect to see price coming to that place again, not unless there is a supply zone above it. In this scenario, we do not have a supply zone. We have an order block, an imaginary order block in this case, because this is not the way I trade. I normally trade from the last opposite candle. I don't trade with the candle that follows the move. This is the candle that I would have placed my entry at, because that is where my supply is. So using smart money concept, you will say this is your order block. You placed your order here and it never got triggered. Now, how do you ensure that you do not get left behind? Because it pains for you to wait for a setup for maybe 3 days or a week. The price has come to your point of interest. You have dropped down to your lower time frame to confirm for the entries, and look what happens. You put your limit order here, or you anticipate to find this price coming back to this zone before you enter. Then you see price leaving you just like this, and then you start now chasing your price from behind. You are not supposed to do that. So once you complete watching this video to the end, you are not going to start chasing the price. You will catch the price red-handed and move with it. Okay, I want us now to combine supply and demand and SMC. Once we combine them, we want to find that precision entry that will not leave us behind whenever the market has come to our point of interest. Step one, where. What gives you where? You use supply and demand, which is S&D. For those who maybe do not understand this, S&D stands for supply and demand. You use supply and demand to find the real institutional zone, the way we did. Number two, you use SMC to tell you when. Now this is the time you need to pull a trigger. So wait for SMC confirmation, structure break, liquidity sweep inside that zone. This will now give you a trigger. Okay, now the results of these two combination will give you very high probability trades, more precise entries, and strong risk to reward. This approach filters out weak setups and keeps risk small. Mark this, it will filter out weak setups. Why do we call them weak setups? They are weak setups because the confluences are not stuck. Now we are going to stack the confluences. Look at this. When this price came all the way here, this is the last candle that swept the liquidity. So this will become our forecast candle. We don't care about any other candles, okay? So after this candle swept the liquidity and went above and touched this zone, this is called the approach candle. When the approach candle has finished the job, it means the smart money made their decision at this point, not here. This is where the smart money made the decision. How did they make that decision? They said from here, we want to push up strongly. For those people who are looking for breakout entries, we'll say now the price has broken out of this consolidation. What are they waiting for? They are waiting for retest of that breakout. So once they get this retest, there's this green candle that will tell them, look, now the retest is complete, enter your buys. Now they're thinking we are going to continue moving up. This was just a trap. So if you did not mark your higher time frame point of interest and you're trading on the 5 minutes, you will not know why this movement is happening. So what will you do? You will enter your buy position at this point because this was consolidation, break, retest. I want to go long. Where am I going to put my stop loss? Somewhere down here, okay? And what happens? This price went up a little bit just to rebalance this inverse fair value gap, and then this price decided to come all the way down here to sweep your liquidity. Okay, once it swept this liquidity, it tried to move up again. Why do you think this price moved up? This liquidity means when you have your stop loss, you are saying, I am buying this market up. But if price goes against me, I'm doing what? I'm selling my position. So once you sell your position, it means the market will buy your position. That is why your stop loss will trigger the movement up, because the market is buying off your stop loss, because you've told them I'm buying the market. But if the market goes against me, I'm ready to sell my money to you. So take my stop loss and exit me. So once the market takes your stop loss, it means they have bought your positions. So when they buy your positions, that is why we see this reaction up. Okay, so when this reaction has happened, where do you think this reaction was going to? This reaction was just coming to retest this level. Remember, I told you the very last opposite candle is where we want to concentrate on. This becomes our supply zone. So the two will help you get a precise entry. Why do you think the two will help you? The thing is, you would have identified the order block above here. So you say, look, I have an order block here. I have my supply zone here. So it means if this price wants to come all the way up here, I'm still within the trading zone. If it does not want to come to this level, still I want to catch my moves from this, because this is the decisional point where the smart money decided, you know what, we are pushing this market up. And once we push this market up, our intention is to sell. but we want to bring as many buyers as possible so that they can put their stop losses somewhere here. Because once they see these huge engulfing candle, some people might have interpreted this as this market was coming down to retest this level. Some people will say, no, look, this was the last impulsive candle that we head to the upside. So what are they going to call this? They are going to call this their demand. Okay, so again, the movement is going to bring in more people. When they call this their demand, they have seen this huge move up. They are going to enter immediately and put their stop losses somewhere here. But the market will tap into the supply zone and then take you to your final take profit. Okay, I hope someone is learning something. So we move to the next page where I need now to give you the final take away. Okay, now when you use supply and demand, it is going to be your map. It shows where to trade from. Okay, the way you saw, and if maybe you've moved very fast to this video, you can watch this video as many times as possible so that you can internalize the things that I'm talking about. You will use smart money concept as your clock. It shows you when to act. I normally say it shows you when to pull that trigger. Okay, so you use them together to trade at the right place and the right time for double edge over the market. You have seen for yourself when you combine the two. First of all, they will help you, they will shield you from entering from poor zones, and they are going to guide you not to start buying when it is time to sell. Secondly, they are going to guide you on where to enter based on the position. Okay, now this is the final move that happened from the supply and demand level that I have been showing you. What happened? This price came all the way up here. This huge candle came to tap this level. It swept this liquidity. It took out all this liquidity, of course, and then tapped into the supply, higher time frame supply zone. After that, what happened? This change of character left behind a supply zone. We say the last opposite candle is where we start. Supply zone is a zone. It is not just one single candle. Okay, it's a zone. For SMC, they are going to focus on this single candle. For me, I don't trade from that single candle. I trade from a zone. Okay, so this zone becomes my entry. When price is coming back, I don't care how many times it's going to touch, because I know this is where big boys have entered their positions. My stop loss is up here. I know it is not going to be taken out. And then if by any chance price takes me out, I will say it is fine. I did everything right. It's only that maybe the market was not on my side, just maybe. But instead of you waiting for your price to be picked from this zone, you have seen you can use a zone. This is lower time frame. So if I could tell you how many pips this stop loss is, you might wonder. It is not even 10 pips. These pips were coming around 5.2 pips. 5.2 pips on Euro USD. That is, that's very small stop loss. But people want to risk only 2 pips as their stop loss. Some people want to put 1.5 pips as your stop loss. You want to get, 1 to 100, risk to reward. That one may not happen, and it's going to cost you long term. So be realistic, know where to trade from, and you are going to make money out of the trading career. Up to that point, guys, if you have found this valuable, do me a favor. Subscribe to this channel, like the video, comment below, and share this video with those you believe need to see this. Bye bye for now. See you